Hi, my name is Jason England, Managing Director and Portfolio Manager here at Simplify, and author of the recent fund insight, A Great Time to Consider MTBA, the Simplified MBS ETF. In response to rising inflation, the Federal Reserve Bank hiked short-term interest rates by 525 basis points over a nearly 2-year period, leading to attractive yields across all fixed income asset classes. Among fixed income sectors, mortgage-backed securities, known as MBS, have always displayed a couple of attractive characteristics. They historically yield more than comparable U.S. Treasury bonds, while at the same time having little to no credit risk. MBS issued by government-sponsored enterprises either have the explicit backing of the U.S. government in the case of Ginnie Mae, or implicit backing in the case of Fannie Mae and Freddie Mac. However, today, MBS are even more attractive than usual, as the yield advantage of MBS over Treasuries, otherwise known as spreads, are trading substantially wider than their historical averages. The gold line on this chart shows the MBS spreads above Treasuries. We can see that over the past 3 years, spreads have widened considerably, making MBS even more attractive than usual. At the same time, investment-grade corporates are trading at historically tight levels, with 5-year investment-grade credit spreads currently trading below 50 basis points, as shown on the blue line, after trading over 90 basis points in March 2023 during the banking crisis. Additionally, even if the Fed's next move is a cut, there is a high probability that the easing cycle will be gradual, perhaps every other meeting, and once it starts, it will mostly impact front-end rates. Back-end rates are more influenced by fiscal policy and the economic outlook, likely insulating mortgages that are based on U.S. 10-year rates. Within the MBS space, newly issued MBS look the most attractive right now, with coupons ranging from 5 to 6%. Unlike Treasuries, where two bonds with the same maturity dates will have identical yield to maturity regardless of the coupon, MBS with higher coupons provides substantially higher yields to maturity. Compare this to the MBS index, which is filled with lower coupon legacy MBS, many with 3% coupons and correspondingly lower yield to maturity. The Simplify MBS ETF, ticker symbol MTBA, takes a simple approach to investing in MBS issued by government-sponsored enterprises. The strategy combines an actively managed core portfolio of predominantly MBS forward contracts, known as TBAs, to be announced, and U.S. Treasury bills as collateral. Rather than tracking a benchmark with legacy holdings at low coupons and longer durations, the ETF is designed to move beyond conventional constraints and seek the best positive absolute returns. Newly issued MBS is found in MTBA are providing higher yield and less duration than the traditional MBS index, as well as corporate and aggregate bond indices. There are 3 portfolio use cases for MTBA for those seeking higher yielding, lower duration substitutes for mortgage index funds, as a complement to an existing core fixed income allocation, and a defensive alternative to credit risk with attractive yields. MBS, especially newly issued MBS, are offering great value relative to many other fixed income asset classes right now. And with expectations of a gradual cutting cycle focused on the front end, now looks like a great time to consider the simple yet powerful exposure to MBS that is executed inside MTBA. Thanks for listening, and thanks for reading the Fund Insight.